and welcome to Trading the Trend. This is Thursday, our normal time we get together. This is not a one-off class. We meet every week, so we'd ask you to join us as you are here today. Just know that this is a live session, but also we'll show you where you can find the recording in just a moment. Also, we have Brent Morris in the chat. We welcome him, and we welcome all of you. We have JP with us, GH with us, Grace, Silas, CBG, Lola, Greg, WW, and many others. Scott Luck, we welcome you. Aloha back to you. My son's girlfriend was living in Hawaii for a little while there. She thoroughly enjoyed it. Can't imagine why she would. I'm joking. Just real quick, as we talk about the focus of this class is where are those trends? Now, we know sometimes the trends, the investors trying to ride those trends. Other times, the investors trying to say, where are the exits? We will cover both the entries and the exits here today as we talk about some management of some positions right off the beginning. Now, remember that with what we discuss as we show our examples, options, we'll talk about stocks. We'll also talk about options. Remember that options carry a high level of risk and are not suitable for all investors. When we talk about some information, the information is provided for general informational purposes only. And also this webcast discusses technical analysis, but there's other approaches like macro analysis, fundamental analysis, intermarket analysis. It's not just technical analysis, and sometimes other things out there can affect what's happening on the technicals. That's why we want to be aware of that other forms of analysis. Also remember that when we talk about examples, they will be done on the paper money account. Also remember that all investing involves risk. And when we talk about short options, those could be assigned at any time up to the expiration, regardless of the in-the-money amount. In our examples, we'll show that right off the bat. Now, also want to give us a quick reminder that when we talk about the agenda, I'm going to talk about current positions right off the bat. Then when we talk, now, by the way, why are we talking about that? Well, you got expiration tomorrow. Some of these positions, just a few, they expire tomorrow. So we need to talk about those. Also, as we talk about some new positions, then we're going to loop back in. What are the indexes doing? What are the sectors doing? And so on. So let's kind of talk about some current positions right off the bat. And one of the positions I want to talk about right off the bat is I want to talk just real quick about this Uber position. Now, if we take a look at, let's say, Uber for just a moment, Uber was a stock position, okay? And what you're now going to notice is we actually sold the call on it. If you have shares and you sell a call, welcome to a covered call. Now, what you're now going to notice is it also has a put, and that's your collar. Collars could be done all at once. Buy the shares, sell the call, buy the put, or you could just buy the shares and then do the covered call and then add the long put. So there's different ways you can get into it. If we kind of said, well, how will we know where this paper was it put in all at once? The answer is it was actually put on. If you take a look at this, it was put on the 7th, and it looks like the call was rolled one time already, okay? How do we know that? Well, because on 7/31, that's different than where the 7/7 is. So what that really means is there must have been some premium received from when we actually put on the call first. And so that $525, that is not including the premium that was received from when the call was sold on the 7th, which is kind of interesting to note that. I'll take a look at that in just a moment. Now, what we have a situation. What's the situation? Well, we actually are literally at 91.36, and we have a put at 92.5. So let's draw this up, okay? And this, hopefully the picture helps and we can draw it fast. 95.83 is where that stock was purchased. We actually said, hey, look, we'll agree to sell those shares. And now this makes sense. You're going to see that the 95 call was sold, which, by the way, is lower than what the stock was purchased for. So this leads us to believe that we had some 97.5 call and it was rolled down, but to the same expiration. Now, on the bottom side, we have 92.5. So you want to ask yourself a very, very hard question. It's a joke. Where are we now? Answer, where are we now? Well, we are literally at 91.44. So I'm a little bit less, 91.44. Now, the language we talked about in terms of a rule set, example given, is we said, hey, look, if we're 4 to 10 days to expiration and we're below, the stock price is below the long put strike price, the paper money account is going to sell the position. So if we were to follow that, how do you exit out of the collar position? So what the investor is saying is, if the stock is closing below that long put strike price, that 92.5, that's not necessarily a great sign. Okay, so let's kind of say we followed that. How do we close the collar? Now I want to ask you a question. Are you comfortable in closing a collar? Do you know how to do it? Well, if we kind of did probably the easiest way first, we'd probably say, look, hold the shift key down on your computer keyboard. And what we're going to do is hold the shift key down and click on the put and the call while holding the shift key down. It just allows us to highlight both lines. Then all we're going to do is just right click. And what this is going to do is it's going to get out of the collar first. In other words, the short call and the long put. Are there any questions with that? Are you good with that? Can you do that? Not can I do that? Can you do it? Can you hold the shift key down, click on both rows, right click, create closing order, and it's going to get out of the collar position. Now, once that position is filled, what does the paper money account have left? Well, what the paper money account actually has left is what? You get out of the collar, the only position left is the shares. How do you sell the shares? Right click, create closing order, sell the shares. All right? So that's what happens. So if the risk to this is, or the concern is, if we let the stock close below the long put strike price, this is the right to sell the shares, 100 of them, at that strike price. So if we do not go in and administer to the position, it's automatically or could be sold. Okay? Just like if this was a long call and the stock closed above the strike, that long call could morph into shares. Well, the opposite of that, if we have a long put and the stock closes below the long put strike, that can morph into short shares of stock. Okay? Even if you don't do anything, even if you don't even know what's happening, that's where you want to kind of really have an understanding. If that stock closed below the long put strike price, what does that do? It sells 100 shares of stock if it's a long put. Now, if we take a look at this, I want to kind of go back to this. Now, I'm going to show you this. Now, by the way, how much did that long put cost? Excuse me, how much did the collar cost? If we just look at these positions, not including the previous roll, it was probably about $80. I'm really thinking that we're still, the collar has been still positive if we include the 97.5, and I'm going to find it in just a second. The real loss, though, is where? Well, the real loss is on the shares. It's about $4 lower than where he was purchased, hence the loss of $4.40. Okay? Now, so we talked about, in this case, how do we shut the position down? Do you feel good about that? If you said, hey, I want to get rid of the position, exit the collar, sell the shares. All right, now, wonder if you said, James, this is so close to being maybe a turnaround position. Maybe I just want to get rid of the collar and just set a stop on the stock. Okay? Now, let me kind of show you what I mean by this. Uber, over the last couple of days, has kind of ran up, pulled back, ran up, pulled back, ran up, pulled back. It's trying to go back up. Now, if I went to the chart and said, where's that break even? That break even is about right here. If we had, I mean, just one good day. Just give me one. One good day, let's say it went up $4, this is where the break-even expiration is. And I'm just talking about the stock, okay? So if we decided in this case, hey, look, I'm going to exit the collar and set a stop, how does the investor do that? It's kind of like what we did before. Let's show this. Some of you might be wondering this. Now, in this case, if we did that, how do we close out the collar? Okay, we'll hold the shift key down. Click on the both rows, right click, create closing order, buy it back. Now, when we do that, and again, it's not if I can do it. I want to know, can you do it? Okay. We're now going to get out of the collar. If you chose and said, look, I think this could turn around and I'm a little bullish of the transports. So that's the thinking. If you stay in this position You're thinking that the transports could go back up, and Uber being one of those. If we go confirm and send, and we send the position, now the risk is, instead of just having a delta of 20 or 30, the delta is 100. So has this portfolio become more bullish or bearish? Now, there's no downside protection. There's no upside cap here, okay? If you have shares of stock, you better get that stock to go up. Are we crystal clear on that? You get rid of the protection, it's all about the shares. Now, let's think about this. If the investor said, hey, James, you know, in this case, I want to set that stop. How do you set the stop? Right click, create closing order with stop. When we go back and actually look at this and say, well, where is that support? And I want to set maybe even a tighter stop, 89.82. This is if the investor said, James, I want to keep the shares and I want to see if I can't get a little reversal. Well, if the investor chose that direction, 88.02, we type it in right there. Remember, with the stop, it's saying if we go to that price or less, it triggers the sell. This is not saying exactly where it's going to fill. Data GTC, there it is. So we went over both examples. Number one is, how do I exit it? Based upon the methodology that we talked about. If you said, James, this is so close to being above that long put strike, which means it's kind of more neutral-ish, and if I get any update or two at all, I'm back to the break even. Now, if I take a look at this, confirm and send the orders, there it is. Now, what I do want to do is I want to go back to account statement for just a second. I want to type in Uber, and what I'm really trying to find in this case is, where was that short call? There it is. We thunketh that the position, there it is, 97.5. That call was sold there. And what you're now going to, and it looks like it was sold for 207, okay? The 207. And so that call was rolled, that 97 call was rolled down to the 95. There it is right there. So it went from the 97.5 call to the 95. Now, let's just kind of say in this case of that call, we were down overall on that position, probably $550, but you got to subtract off the $100 because you got that in the pay money count. And so the position really lost $450 of $112,000. Look, the difference between really good investors and ones that are still working on it is really good investors chip away at their losses. This is the loss if we just closed out of the position today. And this was the roll from the call, roll call, okay? And that's the 97.5 to the 95. So by rolling the call, it cut the losses down 20% of the 550. Now, if we said, hey, we lost 450 of the 112, sorry, I already wrote that there. How much is that? 450 divided by 112,000, let's say 200-ish. This bad position lost 0.01 would be 1%. It lost 0.4%. So if you called up your friend crying and said, man, it's a bad position, I just lost my shirt, I'm down 0.4%, they're probably going to hang up on you. So the thing is, when you have bad positions that do lose money, how much of the max loss does it lose? It didn't lose the max loss. It lost about 20% less than the max loss. And it got helped by rolling the call. So this is one of the few examples of a collar where it didn't go up, where it didn't stay neutral. It actually tested the down long put strike. We talked about what if I want to get out now? We showed that. Wonder if I want to hold it on the position, close the protection out, and try to see if it can bounce. And that's what we showed. So if you want to know what happens if it goes down, those are actually two ways in which the investor could play itself out. Okay. Now, let's go back just real quick. Now, we will come back to other positions, but I need to discuss this. Now, by the way, we have had this in the section of collar. Where should we put this position now? Well, we're going to right click on this. We're going to say move to group. And what we're going to do is we're going to say, we're going to move it to the stock section. So if we did that and said, well, how many positions do we have in collars? The answer is none. Okay. So we could close that down. And now what you're going to see is we have two stock positions and the rest of them are short puts or short verticals. I like to keep them categorized like that. I like to know what I'm looking at. Okay, it makes it easier to manage the positions. Was that helpful? Okay. Now, I know a lot of times you ask, well, what happens if it goes down? I wanted to talk about right up front, what happens if it goes down? Now, let's go back to the market just real quick, and we're going to kind of take a look at some interesting. So earlier today, we had the PPI, the Producer Price Index. And so earlier in the week, we had CPI. Today, we had PPI. So more of the story, what we're talking about is inflation. Inflation was hotter than expected. And like we said yesterday, so Scott asked the question yesterday, what if PPI comes in hotter? Okay, what if it does? Well, yesterday, as of yesterday, there's a 100% chance of a Fed rate cut, 25 basis points in September. Well, with the inflation report coming in hotter than expected, what we said yesterday and what happened today is we said, hey, if it runs in hotter than expected, it's probably not going to be 100%. It dropped down to, as I checked earlier, to 93%. More of the story, could they still cut in September? Yes. But maybe that secondary cut might not come as quickly. Did it really move the market around? Not a whole lot. I mean, I think investors probably would say, give us the rate cut sooner than later, okay? And if you take a look at this, the S&P is kind of still holding there. So there was no crash. Now, what was, the movement we talked about yesterday is when you look at the Russell, you could see that index is begging, please cut the rates. And I just think this is still laughable that the Fed, Jerome Powell and team, they're so hawkish on cutting the rates because of inflation, but really we're so slow to increase the rates when the CPI and the PPI were 8 or 9%. So it's so awkward how they don't raise the rate when it was at 8 or 9%, slow. And then now when the inflation is, 3%, we can't cut. Well, where the heck were you when it was at 8 or 9%? Remember, these are the same people that have Harvard degrees, went to Wharton, Thunderbird, the whole 9 yards, MIT, and literally on one side, just late as ever. On the back side of this, when the rates are high and trying to come down, all of a sudden, now it's almost like they realize they made a mistake and they can't get this one wrong. You would have thought that on the front side too, but that didn't happen. Now, the real person or the investors or the Americans that really got hit by all this was the savers. The savers were really used as a cheap form of financing. They really didn't allow the savers to actually make a higher rate of return because they kept the Fed funds rate low, which affected CDs, which affected treasuries and the whole 9 yards. So that's really, I think, when you say who really got hit by the brunt of this, it was the savers. And there's some comments you could say on that, but that's really who kind of financed being late. They were the ones who said, hey, I missed the opportunity to make more on the capital because they never raised the rates to match the inflation. Yeah. Geez, my gosh. Good thing we talk about education, okay? And that's why so many investors were investing in stocks because they weren't getting the rates of return on cash. So that's why you want to be made aware of different types of investments. Now, what I want to do is when we talk about the NASDAQ, you're going to see that the NASDAQ hit a high yesterday, today, falling down just slightly below the 10-period moving average. Now, when we talk about, let's say, this that new asset class, last night touched 125,000-ish. Didn't stay there, but touched it. And if we take a look at, let's say, gold is still under pressure. You can look at that on your own. But when you go, let's say, communication, that doesn't look bearish. I mean, banging new highs, doesn't look bearish. You take a look at financials for just a second, still pushing back to the upside. Discretionaries, if you take a look at that doesn't look bearish either. And obviously, if we look at technology and semis, those probably aren't bearish either. So you kind of still have a catalyst of where the flame is: communication, technology, discretionaries, semiconductors. I'm going to include there financials as well. Industrial's a little softer. Now, I want to come back to the example that we talked about with Amazon before. Now, we have really been trying to focus on understanding the bounce. Now, I didn't realize that on my chart, I still had the notes that we wrote from I think Tuesday. Forgive me. Now, remember when we talk about, let's say, a bounce, we've really been focusing on this 1, 2, 3. Okay. Now, I'll be honest. Okay. So I have 4 kids. Okay. Why didn't I have more kids? Well, when I say Zach, Caleb, Colton, Abby, okay, and Jax, if I include Jax as a 5th kid. Look, more of the story is you want to make it as simple as possible. So in terms of trading investment, we're going to focus on 3. Okay. But so there is a point where counting to 12 it's not helpful. So we said breakout, it turned, you get a breakout and it makes a higher high. The key is it's above the moving averages. The moving average MA could act as support. Okay, fine. Now, what we've been talking about over the last couple of days is looking for those red candles. And we're really talking about how many red candles do we get? Well, 1, 2, 3. Okay, now, if we take a look at that, tell me about that candle right there. I want to know, James, from you, BJU, PAU, tell me about that red candle right there. Why is there a lower shadow on there? Now, Pia, it's okay, or James, it's okay to say, well, I'm the one that caused that lower shadow. I stepped in and I caused that intraday low to occur, and by the end of the day, there was a hammer. Now, that's always laughable when we say that because, there was a friend of mine, he goes, yeah, Apple made a hammer when I got in my 25 shares. And I just put my arm around him and I said, man, that's what I love about you. You think your 25 shares really pushed the Apple position that day. Yeah, as soon as I got in, it hammered. That's funny. Okay, now, but there were some people that were kind of buying near that moving average. Now, if we look at this and say, well, how many red candles did we get? There's 1, 2, 3, right? And it left a long tail. Now, if we go to the very next day, number 3, the process of a higher high there to a higher low there and here, you might start to see Cahold. Now, what we try to do is we try to put little green chocolate chip cookies on the chart. Now, that green dot is just signifying, hey, close above the high of the low day. Now, don't worry. You can't say the Amazon is in the Russell 2000. It's hard to go through 2,000 stocks. It's not. It's in the Dow 30. And if you did your homework, you probably saw that, okay? If you didn't do your homework, as my dad would say to me, you got what you deserved. You missed the opportunity. And you didn't get the opportunity because my dad would say to me, you weren't prepared, so you shouldn't deserve anything. My dad came from a farming background. You don't plan anything, you don't get anything, okay? You don't even have the chance to get anything. Now, if we look at Cahold, there it is right there. So by the end of that day, it was really trade above the high of the low day or close above the high of the low day. Now, I'm going to tell you right now, there's a lot of people that are sometimes late. The Southern little joke is sometimes the people are so late, the only time they'll ever be on time is to their own funeral. In the stock market, I'm not really sure if that's the greatest way to go. So if the investor wants to have solid entries, so right here, process of a higher high to higher low, the investor is looking for that Cahold. The investor might also be looking for, let's say, the gap. Well, hello, if you're kind of doing your due diligence this morning, you're looking at which stocks might be gapping up a little bit. There was a pretty good gap. Now, how do we know it's going to go higher? You don't know it's going to go higher. What causes that gap? Because the people, and this, I want to stress this, not everyone is waiting until the market goes open. There's people that buy, let's say, 3-4 hours after yesterday's close. There's people buying 3-4 hours before the market even opens. Okay, they're not waiting until 9:30 Eastern. You could do that. There's pros and cons of that. But a lot of these things have become more liquid or they're trading outside the standard market hours. Now, this is kind of amazing because now you've seen it shot back up, and this is where the investor, oh my gosh, I missed it. So we're just trying to do the same patterns over and over again. Now, I want to kind of say this. If the price is not above the 10-day moving average, how much pressure should the investor feel? 0. So if the investor said, hey, I pulled up a stock, IBM, and the stock is below zero, how much pressure do they feel? Zero, because the stock's going down. That's a trend that's downtrending. The trends, if they're trying to ride upward trends, they're only looking for the stocks that are above the moving average, the 20 or the 10. In our case, we're looking for the 10 minimum. That's the foundation of the trades that we actually look at. Now, the investor might say, well, James, I'm too late. Wait, so why would the candle be this large if all they thought is that it could go up to here? Now, I know in our minds, we're kind of thinking, well, this is resistance. Well, this is the resistance right now, but who's to say that this is not going to just leg kick through the resistance, okay? And we got to get this out of our mind that resistance is always going to be the resistance. Eventually, the Berlin Wall fell too. So if we take a look at this, now they left a little section if you've ever been in Berlin. They left a section, but the majority of it has been knocked down. The biggest actually thing is we're going to go back to the trade tab here for just a second. Trade tab. And we're going to go look and just take a quick peeky and see if there's any administration of positions. What do we have? What is in the paper money account? Question should be which account? Okay, now, what position is this? How do we make sense of what is going on? So it looks like we got a 210 put, and then we got, let's say, the 220 short put and the 210 put. Now, what is that? Well, that's your classic short put vertical. Now, that's sitting right here about 50%. Now, it's not 50, it's 50. Okay, if you live down south, 50. So that's about 50%. Now, that's just one contract. Now, by the way, that's with 36 days remaining. Okay, it's not bad. I mean, 50% gain. And when was that trade put on? Answer is the 24th. So if we take a look at this and say, what is this other position? Well, that position right there, that's your 220 call. You bought it, okay? The 230 call, short. And what you're now going to notice, that's at 50%. Now remember, these are 50% with 36 days left. So the investor might say, you know what, I'm going to just kind of take out a little paper money envelope and try to stuff. Now, you can't do this in paper money, okay? But imagine hypothetically, in imagination, in a simulated trading account, you took out a paper money envelope and you said, I'm going to grab that, create closing order, and I'm going to buy it back. Bad thing about these verticals, boo, is there's only a cap of what the investor can make. The other bad part is you're only making like a little fraction of really how much that stock went up. So that's why there's some people that say, I like to do stocks or synthetics. Now, what I'm going to do is I'm going to take these positions down. I'm just holding the control, and I'm just going to highlight both of these, right click, create closing order, and I'm going to try to grab that profit. Now, I need you to say with me, I like to take profits. So can you say that with me? I like to take profits. Sometimes people are so nice that they want to feel so right. The paper money account did not get in the position to be just right by itself. It was to be right and make profit. Okay, now here's the deal. You got to go ahead and grab it, okay? So now what we're going to see is can we get out of the position and close it down? Now, so what we did is we got out of the short put spread. We got out of the long call spread. And what we're going to go back and do is we're going to say, could we look to do it again? Now, there was some news about Amazon in general here today. I want to go back to Amazon. And if we kind of look at this could be setting up like a pretty big V pattern. Now, I don't know what your favorite letter in the alphabet is. If you ask me, it'd probably be W, and it would probably be V. Of those two, which one is the favorite? Oh, okay, I can't tell you. But you got a 50% chance of hitting it. Okay, but there is a favorite. Okay, I'm looking at it. Got a 50% chance. Now, here's the deal. If this stock were to actually go to the upside, the width from support, the bottom, up to the resistance, that is a pretty big channel. Now, I'm never thinking it's going to do it completely. I'm always a little pessimistic. And let's say I said, look, potential target $60 here. Now, the investor has that top, they might say, look, I got a target at $290, whatever. But some investors might say, James, if it even goes half that, I'd just be grateful. Okay. But so the thinking is kind of even foundationally, just couldn't break through there. Okay. Now, what I'm going to do, now remember, we talked about this with kind of some historical comments. Let's say the investors say, look, I think this might try to go to the upside, further break out. And what you're now going to see is we're going to go back to the paper trade account and we're going to go look at the 19 Septembers. And let's say I chose to do something. Now, you tell me, is this more aggressive or conservative? A friend calls you up, named James, hypothetically. There's other Jameses out there. Okay, James Allen with us. Let's say the investor says, you know what, I've been kind of practicing these put spreads, short put spreads, and I'm going to do the 230, the 220. And then you kind of register what that is, and you say, wow, that is conservative or aggressive. What would you say? Now, wait, if you sell the 230, I mean, you're right there. You are right there. I tell you what, if this thing rams to $10 up, just rams into the close, this is going to be interesting. Don't know what it's going to do. We don't know. I'm just saying sometimes, just like Apple, where it kind of had a little up move and then it rams into the close higher. Okay. Going to have to wait and see what it does. Now, what we're going to do is we're going to do the 230, 220. Okay. And let's say the investor says, look, I'm going to try to get a $3 credit. You got a $10 spread. It's about a $7 potential risk given the vertical. Well, we know that if you sell like an at the money strike that probably has a delta probably between 40, 45-ish, man, you obviously clearly are thinking, I think my technical analysis is showing bullish, okay? You wouldn't be selling that close to the strike unless your technical analysis is pretty optimistic. Now, if you're wrong, there's a built-in maximum loss right there, given the vertical. So let's say the investor says, look, trade number one, we're going to take that position. Note the commission, okay? Note the commission. Send the trade. And trade number one, what we're going to do there is we exited the position we have, the short put and the long call, tried to put that in the paper money envelope, okay, profit envelope. Then we actually said, look, wonder if the investor were to decide to go a little bit more aggressive. And they chose to go the 230. Now, we normally don't show that. But if the investor said, you know, James, YOLO, what does that stand for? I had to ask my kids, what is YOLO? Your parents are old, okay? You got to tell me, I don't know what YOLO means, okay? You only live once, they told me, okay? And what I said back to them is I said YOLO really means you only live once here. That once you leave, you're on your own. Good luck. Anyway, my wife said that wasn't very funny. Now, let's go back to another one just real quick. So first of all, are there any questions? I didn't think what I said was funny. I was serious. All right, now here's the deal. If we go back to, okay, just looking at any questions. Yeah, so Kelly actually says, and by the way, this is why we all get together, okay? It's nice to kind of learn off each other, okay? So Kelly says, ATM at the money is at a major support. Well, let's see if Kelly, let's check Kelly. There's nothing wrong with checking Kelly. Let's see. So when you say major support, well, you might go back and kind of say here, okay? Now, if we went back to, let's say there, and those are kind of some levels. Now this is on the weekly. If I look at let's say the daily chart and say, let me see at the money let's say, if someone were to say that to me, let me move this over. If I said major support, well, there's your breakout, right? By the way, I just love that because that goes down to the gap down. Remember we talked about gap down, the open price becomes the resistance? Boy, that was a nice little setup. Old resistance becoming new potential support. And if we said gap up, you know, I think if we said kind of maybe a potential support, it's probably 227 if we said where it gapped up to, and then underneath, let's say 224. Now, what was the strike that was sold? Well, the strike that was sold was the 230. So that, we don't have 227, but if we sold the 230, we're kind of thinking that where we gapped up to might act like a potential support. Man, I'm telling you, feel bad for the people that didn't watch that gap down reversal class. That makes me feel sad if they didn't see that. All right, now let's kind of go back to, just real quick, I'm going to go back to, let's go back to Netflix for just a moment. Now, I want to kind of just take this, I'm going to kind of fast forward this, okay? So there's kind of like a downward sloping line of resistance. Now, by the way, you can kind of say that when you see these type of slant downs like this could be half of the V. It could be, right? It's just kind of making those lower lows, lower highs, lower lows, lower highs, lower, okay? Now, when the prices get below, let's say, example given, the 10 or 20 period moving average, you're going to see some very nasty price action. And I lit it like that because historically, I used to hold positions when they were below the moving averages. And I'm telling you, if there is a time where you'd say, man, I cannot believe how far and fast it could go down, just find an investor who has held stocks below their moving averages. It is the most painful thing, okay? It's literally like just, I'm not sure if one word completely describes it. It's just like how bad, and every time you see a green candle, get your hopes up. And every time you see a green candle, then all of a sudden, 1, 2, 3, smash of red candles. In other words, you can't ever really get a consistent move to the upside. And welcome to bearish momentum. So in this class, we don't talk about any stocks below their moving averages. Why? Because those nasty bears are controlling, we're just saying nasty price action, in other words, lower lows, lower highs, negative sentiment, etc. And now what you're going to see in this case is just selling pressure. I mean, we can't even fight our way out of a paper bag. And every time we went up one day, they sold it again. And this is most likely investors that are using an up day to try to sell more. Sell more. Anytime the price goes, sell some more, sell some more, sell some more. These are not people that have 100 shares and 50 shares. These are people that have hundreds of thousands, tens of thousands, millions of shares. And they're using the up days to try to sell more, and it creates lower lows and lower highs. Now, what you're now going to notice is when we got a little push to the upside, we all of a sudden, when we got the piece to stay above the 10 period moving average, hallelujah, that's where those bullish technicians are thinking, oh, feels so great to actually be above the 10 period moving average. Maybe we can get like a couple green up days with only 1 or 2 or 3 down days. It's the flip of what we actually saw with Netflix. And I'm telling you, if we took 25 years of, like me investing, 30 years, I don't know how many ever, it was 1986 when I started. If I could package it in 5 minutes, if you understood what I just told you, you would say, man, I think maybe a good thing to kind of consider is be very careful. It's below the moving averages because it could go a heck of a lot further down. And where was the exit? And if the investor's trying to ride the trends, they're trying to look at the right-hand example. Now, the reason why we're bringing this up now is we had 1 day down. Now, remember, 1 day down doesn't necessarily mean it's bearish. It just went down for a day. And all of a sudden, what do we actually see on the chart? Well, you're going to see on the little chart a little close above the high of the low day. Now, what we got to get out of our mind is, oh yeah, this entry is guaranteed to go up. Every entry has what? Every entry. Every one of them. What is it? 4-letter word. Risk. Okay? Now, what we're going to do in this example, we're going to go back to Netflix for just a moment. We're going to take this position, and let's say the investor said, you know what? I want to go in and maybe try to, I want to take a more of a long call vertical. Now, in our minds, if the investor said, I'm going to do a long call vertical, they want a higher potential upside. They think they can get that direction right. Now, I know some of you nail that direction. You're like, James, if you want to know which way it's going to go, I'll tell you. It must be nice. Now, what you're now going to notice is, let's say the investor said, I'm going to buy, let's say, the 1220. And in this case, and I'm looking at this wrong, we're going to go look at the 1240. Why did I change my mind? I was kind of looking at the bid-ask spread right there, okay? Now, in these higher price dollar stocks, they widen out, but they still have open interest. But the wider the bid-ask spread is, this is probably not something that's going to be gone in and out and trading on a shorter term chart. We're going to need this thing to move to overcome the bid-ask spread. We're going to right click on this chart, buy. We're going to go right to where it says vertical. If we did, let's say the 1240, which is the at the money strike, and we sold in this case, the 1260, the debit there is 988. Okay, now, if we got a $20 wide spread, less the debit, this is actually going to give us, let's say, the max profit and max loss given the vertical. Now, here's what we kind of need to understand on this is, so if this went down and closed below both strikes, the investor is actually willing to risk, after thinking upon it and questioning, is this okay, $989. Now, if that's what the investor wants to do, we're going to go ahead and send the order, and there it is. Okay? So just like we saw with, let's say, Amazon, we're trying to catch it on that first up day. Now, I know what you're thinking. I sure hope that it does what Amazon does. Well, you always feel like that, okay? It's all about you, okay? It's all about you, WIFM. What's in it for me, right? You're always thinking, man, if I get it on a bounce, okay, I hope it goes up. You're always thinking that, right? Now, what I also want to kind of do is I want to go back to just real quick, just flash a couple stocks. Google has actually been quite strong. There's been some discussion upon would they sell Chrome? There's a potential buyer for that. And it has had a big continuation pattern. Do want to point out on Google, there is not much of a pullback and or flag on this. Not all cups or V patterns have to have a flag. Matter of fact, if they don't, it might suggest stronger potential upside movement. It's a potential. So keep an eye there. Now, Meta, when we actually fast fire this, it's still kind of triggering a little bit. Old resistance becoming new potential support. This is your classic down day, close higher day. So when we talk about this, this is the close higher day and where the investor is looking for the what. If the investor says, James, I see the price above the moving averages, check. I see a red candle, 2. I see 3, a green candle, but it is not close above the high of the low day. Now, what the investor might say is, James, I'm going to look for in the morning, I'm going to look and see if the stock gaps to the upside. And if it gaps to the upside, it's higher than where it closed yesterday, some investors, like we saw on a couple of these stocks lately, they might be buying the gap. So we call that down day, close higher. That's not a to hold. That's not a hold, right? And then it gaps. That's a secondary way to get the bounce in the shorter term. Okay, now, when we also go back to, let's say, just real quick before I look at questions, Goldman Sachs. So price above the moving averages. Still, it made a higher high. Okay, so that was kind of process number 1, right? And then we actually said in this case, 2 is going from a higher high to a higher low. How many red candles do we get? We said before, red candles, per kind of examples that we show, they're not entry signals. They're not, per our examples. Red candles are the kind of the exhaling of price. The investor is looking for green candles. Okay? Now, do you see anything on this chart that where the investor might say, James, I'm going to start to pay attention to this? Goldman Sachs went down to the rising 10-period moving average. Somebody was watching. Was it you? Price went down near the 10-period moving average. Someone just randomly bought right near the moving average. Randomly, yeah, right. Okay? So all of a sudden, now let's say the investor says, look, I'm going to set a buy stop at, let's say, 750-ish. Why? Well, because which of these red candles is the lowest? It's the 813. I know you're thinking it's so sad. I like to set that trigger off that 814 day. And just to show you a little variation, let's say the investor says, look, I want to buy the shares here, okay? And let's say they said, look, I want to buy the shares here, and we'll put a dollar amount here. Let's say the investor said, I'm going to put $6,500 in, okay? And let's say the investor said, look, if we got to 746 and I'm using today's high GTC. So this is saying if we get to this price or higher, buy the shares, and the stop could be set underneath last point, 731.71. And if we took less 2%, well, we're going to put it right here. Now, remember, this entry is different than what we normally talk about because we normally look for the lowest down day, and it's there. But let's kind of practice even taking one a little higher to show a little variation. Is there any difference? I know the answer, but let's help you find out. Now, what I'm going to do is go in our third final trade here as we close. There's the stop GTC, okay? So I got to wrap it up here. But I want to thank you so much for your comments and your questions. The things we actually really talked about, they're principles and practices. Principles are timeless, practices are timely. Now remember, with what we discussed here today, it was done for example, illustrative purposes only. And remember that with what we talk about, all investing has risk. Stay tuned for our next webcast coming up right at the top of the hour. Thanks to Brent Morris for answering those questions in chat. I will be back on later today with after the close. And I'll be also back on tomorrow morning with ETFs. This has been the class on trading the trend. Subscribe and follow us. That way you can actually see all of our content right on our YouTube page. Thanks so much. Take care. Bye-bye.